All right, we're in Ohio talking with Scott. Scott, you're with Allworth's Money Matters.
Yeah, hi Scott. Hi Pat.
Hi.
Hi.
I want to let you two know that I am an avid listener of your Saturday morning podcast for many years, and during that time, I have managed to pick up a few financial nuggets along the way. So I thank the two of you for that.
Thank you.
Probably a mistake, but
It's been very helpful.
What can we do to help today?
Okay, so I'm a firm believer of the Roth IRA, the Roth accounts, whether it be through my company, initially Roth 401k, to now in retirement, my Roth IRA. And during the last few years, I've done Roth conversions. I've contributed to my Roth IRA accounts, and the 5-year rule gets thrown in my face all the time. So what I'm wanting to
wait. When you say that it gets thrown in your face, other people tell you about the 5-year rule?
Well, yeah, they tell me about the 5-year rule, what that consists of. So my question does center around the 5-year rule item.
Okay.
And
then I'm going to tell you why it doesn't pertain to you. But go ahead.
Yes.
Okay. Well, hopefully not. So the 5-year rule, I know it only pertains to earnings and not what I contribute. So who keeps track of when the 5-year rule ends?
Nobody.
That's brilliant. That is the best question we've had in a long time.
Nobody.
No one.
Well, I've asked that question of many financial, and I never get a response. I never get an answer.
Look at a lot of the tax code is voluntary compliance.
That's right.
A lot of the tax code, 529 plans, right? Have you ever seen anyone audited on a 520 plan? Have you ever seen anyone audited in a Roth 5-year?
No, never.
No, never.
Well, then it's very rare someone takes money out within that 5 years.
That's
particularly
right.
someone who really loves Roth, the firm believer in the Roth.
Which is the last dollar to be spent. But your question is actually, it's a brilliant question.
Because, there are some laws that get passed, regulations that require financial companies to do certain things.
Reporting of income.
How much dividends and what transactions occurred in your account last year. And required minimum distributions. What is the required minimum distribution?
But none that are required on a Roth.
Really? I thought they were required as going through a financial institution. They were required at the end of the year to provide a form telling you what you have contributed to your Roth IRA.
That's right.
Or traditional IRA.
But there's nothing to say that. When was the first account opened? When was the first Roth contribution made? There's no requirement.
There's no requirement for that to the financial.
Otherwise, yours might say, first contribution made in 2006.
Yes. So when I convert from a traditional IRA, maybe in stocks, and go over to my Roth IRA, keep it in stocks, and I sell the stocks, my Roth IRA, and do something else, I lose track of what I'm doing. So you're telling me I don't have to worry about the 5-year rule?
Have you taken money out of the Roths?
I have not. No,
okay.
I don't plan on taking money out of the Roth for many, many years.
Okay.
So it'll be more than 5 years since the time you made your first contribution or the time you made your first rollover. Conversion.
Okay, so it's really not applicable to me, but it could be applicable to somebody else.
But the reality is, normally when people use Roths, they use it to feather income.
They're voluntarily paying additional taxes today that they don't have to pay, right?
Right.
Because they could have made a pre-tax contribution or they didn't have to do the conversion. So these are people that are planning their finances, stating to the IRS, look, I'm going to send you money today in exchange for the promise that Congress made, that let's hope they're going to be good on that promise when I pull my money out 20 or 30 years down the road.
Right. So your point is well taken, but it doesn't happen in reality. When you see people take money out of a Roth, what they're doing is they're trying to keep they need X income, and they're trying to keep themselves below a marginal tax bracket. But the reality is most of the people that have money in Roths also have money in a brokerage account.
Of course.
Right?
Absolutely.
So, I can't. I'm trying to think of when I've had money come out of a client's Roth account. I cannot. Can you?
Yeah, I had someone do it against my recommendation.
Oh, I can't.
And by the way, you mentioned sometimes we fire clients. That's when I fired. Yeah, I think about it.
They just
I
went to-
think I fired 3 clients in my career. That was one of them.
Because they're not taking. They're doing harmful stuff to themselves.
What's the point? I don't need. I don't need you. I mean,
Oh, don't say that. We like clients.
I love clients.
Okay.
I don't love clients that don't take my advice. That do things contrary to my advice.
That are going to be harmful.
What's the
to
point?
themselves,
Why don't use me? I mean,
but yeah. So your point is well taken. But it doesn't. It's not real. It just doesn't happen. I wouldn't.
You don't have to. You Scott, your net like.
So if I were to ask an IRS agent, he'd tell me something differently then, right?
Why would you be talking to an IRS agent?
No, I won't. No, I don't. No,
He might not even know what you're talking about.
Yeah.
Well, maybe so. No,
I mean, out of all the things that they look for tax compliance, that's because it generates. By the way, what's the point of it? I mean,
yes.
They would just assume you pull money back out of your Roth and put it in a taxable somewhere else.
yeah, but
I would think so.
But what's the point? Think about this, Scott. What's the point of it? What's the point of the 5-year rule? Think about. I never understood why it matters.
Yeah, it didn't make any sense to me.
I mean, I understand the 59 and a half.
Well, I don't understand why it's 59 and a half.
But I
That's just a
understand
round number.
Older age.
Yes, that you have to start withdrawing. And the required minimum distributions at age, 73, 74, 75.
That doesn't apply to Roth.
Yeah. Anyway, I'm just going to, Scott, let's find other things to think about.
Yeah. Is that Scott? You are a blessed man. If in your financial life, this is the one thing that you have to worry about.
Well,
Everything else is so great.
Okay? But
What was that? What did you say?
I do sleep well at night, so I'll just put the 5-year rule out in right field. Don't worry about that.
You're never going to have to. It's never going to be an issue.
And
for
do
you.
do us a favor. Share this podcast with your friends, especially since you are one of the main attractions. You are the star of the show at this point. So
That's
if
right.
you could share it with your friend.
Well, my name's Scott, and of course we got Scott on the podcast too.
Yeah,
but,
but we're trying to
If you meet anyone named Scott, it's always someone between age 50 and 68. How old are you, Scott?
I'm 70.
Oh,
but
I missed about 2
But I
years.
act like I'm 50, though.
Okay.
I act like I'm 50.
got it. All right, appreciate the call.
Yeah, thanks for calling, Scott.
Thank you, sir.
Yeah,
Thank you, gentlemen. See ya.
I saw it on the Roth. The majority, roughly half Americans pay no income tax, right? Because you get a standard deduction.
Yes.
No income tax. So those people, if they're saving for money in their 401k or IRAs, it should clearly be in the Roth.
That's correct.
They're either in a 0% tax bracket or a very 10 or 12% tax bracket. It's only, I think, like 15 or 18% of taxpayers are in a tax rate higher than that 12%, that first bracket.
Say that number again.
It's like 18% of taxpayers.
So
half of the revenue comes in from the 1%.
So that would be 60% of the population is below that bracket.
No, like 80%. 80% of Americans should be using a Roth 401k.
All right.
Like there's no questions even asked. Like just should be Roth.
But the reality is those people
Those aren't
don't
the
have
ones
any
that calling
money
us.
and they don't have any money to save. They're living. It was like growing up. My mom used to say, "Oh, we should have bought that. We should have bought that property down the street, like 20 years ago." I'm like, "With what? Where were you going to get this magical money that we were all of a sudden becoming land barons?"
A couple of years ago, I was up in Tahoe, and there was this one area of Tahoe. These lots were sold there $300 a piece in like 1930 something. Okay. And someone said, "Why? It wouldn't be good if the family." I'm like, "Who had $300 in the 1930s? You're in those
Rich people." Okay, so the point being, the Roths.
But if you're in a higher tax bracket, then you got to really look at it. Do you want to do a pre-tax or a post-tax? And if you're going to convert, how much do you convert?
And when?
And so it's the beginning of the year. I went onto my own 401k because the contribution limits increased this year to increase what's going in. And I do before tax. And I thought about doing Roth.
And
I went before tax.
Because?
There's a chance federal income tax rates will go higher.
Okay.
Right? I mean, there's clearly that can happen.
And
And
I'm interested in this.
there's also a chance that maybe there's a complete reform in taxes, and we now have a national sales tax with a lower flat tax rate. That's in the realm of possibilities.
Okay.
There's also a possibility I don't stay in California the rest of my life.
That's probably the biggest one. Do you really think that we'd go to a flat tax or a VAT tax?
And there's also, I'm probably not going to spend
some
all
of
the
it's
time
going to go to charity.
Yes.
Right.
So with all those factors, I went, and I don't like the way California spends money, so I just assume take a pre-tax.
Why would you say that? They just laid 22 miles of the high-speed rail. They've been working on it
20 years, $100 billion.
22 miles. Come on, Scott, it's 22 miles. It's a long way, 22 miles.
$26 billion on homeless.
Holy smokes. So back to that, the tax. Do you think that we would ever go to a flat tax? I just can't see it because it's not
Politically.
It's not progressive. We have a very progressive tax system.
Right. That's why half of Americans don't pay any
Correct.
income tax. Now they'll pay payroll tax. They'll pay Social Security, of which they'll get a benefit from.
Yeah, but so if you went to a flat tax, would that not be considered a regressive tax?
Well, wouldn't
A sales
right,
tax.
It's by very nature, a sales tax would clearly be regressive.
Yes,
because higher income people don't consume all their
that's right.
income.
Yes,
and to your point, if your mom's saying, "Oh, I wish we would have bought that property," there was nothing. I mean, there's barely like which bill do we pay this week?
Oh yeah, I always got a kick out of that. Never said anything though because I love my mom dearly. Didn't want to upset her, but I always thought, I grew up in this house. I don't think there was money splashing around.
It is clearly possible that tax rates are lower, and we have a national sales tax, value-added tax. I mean, the EU's got it. It's 17, 22% somewhere.
But they have a progressive tax rate as well.
Yeah, but not both. A lot of countries are lower than ours now.
All right. Well,
I mean, I think part of it, when you're considering things like Roth, and
you've got to take legislation into account. You have to recognize
what you're
that.
betting. You are betting that the tax code's not going to be dramatically different, and that your withdrawals will be tax-free.
That's correct, right? So
it wasn't that when I started in this industry in 1990, there used to be an excise tax
on pensions, wasn't it?
On 401ks of greater than was it 750?
Yeah, there was a name for it.
It was a 15% excise tax.
Yeah, what was the name for it? There was a name for it. There was a tax code.
I remember numbers. I don't remember names. But there was an excise tax.
I remember this.
If you had a lump sum larger than,
yes,
I think it was 750, wasn't it?
Yes. Yeah,
there was an excise tax.
We were retiring.
So put that in today's dollars, that'd be like $2 million, $2.5 million. There was an excise tax.
Yeah, so the money would go into an IRA, but you still had to pay a tax on that transfer.
You paid an extra tax for doing a good job saving.
Yes.
So when even when you're looking at Roth conversions, some of those things like.
Yeah, just don't buy in 100%.
That's right. You want to diversify your tax strategy the same way you think about diversifying your investments.
Yeah. You know, I was talking to a friend the other day. It's like, it just blows my mind that we get people to qualify for the Obamacare insurance that are worth millions and millions of dollars. These clients are worth millions and millions of dollars. And they get this
subsidized
health insurance because of how we negotiate through the maze.
That's because it's not based upon assets. It's based upon.
Did you just find that a little bit crazy?
There's lots of crazy things.
I don't know. I just find it just, and I participate in it. I'm helping them.
I had a conversation over the holidays with a family member that there was the discussion on lifting the cap for Social Security taxes on wages.
Okay.
Right. So what is it, 170 grand a year, somewhere in there, where you pay Social Security taxes up to that point of your wages. Above that, there's no tax.
Yeah, and on both sides, and then Medicare goes unlimited on
Medicare
income.
goes unlimited. Yeah,
on earned income.
Correct. On wage type income.
Yes,
or self-employed income. And so I was talking to this person that they thought, well, it would seem to be fair there shouldn't be that cap on there.
Why? Well, that's what you said.
Right. Well, no, I said here's the challenge. When we've got the top tax rate at 37%, Plus, we've got the 3.8% excess tax,
I don't whatever that. Yeah.
which is 0.9% above the Medicare tax. So let's call it 40%. I'm a resident of California. The top rate there is 13.3. So now we're at 53%.
And you don't get to deduct state against federal anymore.
That's right. And so, you pay both sides. So your employer pays half, you pay half. So now
you're at 65%?
Right. So I said to him, the challenge with this,
65% at the marginal rate.
the people who are having these tax problems are the ones, typically business owners that have been successful. They build businesses and this. I said, if we adopted this, what's going to happen is a business person can say, do I want to take the risk to grow my business?
It slows innovation.
Because someone's like, if I lose, no one's going to bail me out. It's all on me. I can't deduct a capital loss except
against income.
Right. So I'm stuck. No one's going to bail me out of my capital loss. And if I do extremely well, they're only going to keep 35 cents on the dollar.
But you could carry that capital loss $3,000 a year forever. So you got that going for you. But you can't inherit it. You cannot inherit a capital loss.
Yeah,
it goes
it
away
dies,
at death. Right?
Yeah.
It's pretty disappointing.
Well, hopefully you don't have a lot of losses.
I don't. It's theoretical.
Yeah, I mean,
how did the argument?
I don't know. That was
and that was it. And you're like,
I said, get the hell out of my house.
Can you pass me the mashed potatoes? And what is that Jello thing?
It was a good conversation. It was just.
Are those marshmallows in the Jello?
You have those too.
Oh my God!
I'm kidding.
All right, let's go. Let's move.
Yeah. So